Welcome. We are so excited that you are here today to learn about our newest investment opportunity. It's a property, two properties actually, down in Myrtle Beach, South Carolina. I'm here with my partner, one of my partners at Rockridge Investment Group, Kevin Dean, and he's going to share more in a second. But I just want to thank you so much for coming today. I know that life is busy, you've probably got a lot going on, but I appreciate you taking some time to hear more about this opportunity. We're really excited about it, and there's just a growing market happening in Myrtle Beach, and we're getting two amazing products at a really great price. So we're going to dive in. I'm going to pull up the presentation and we're going to tell you all about it today. So sit tight and feel free to reach out with questions. We're happy to answer those. Let me pull up. You'll see the presentation here shortly. All right, Kevin, let me know if it's not working.
Good.
One up for you. Perfect. Perfect. So our properties that we are acquiring is called Bells Lake and Coastal Wind. My name is Rebecca Taylor. I'm from Tailored Investments. We find, analyze, and acquire income producing assets around the country. We are mainly focused on multifamily and assisted living. We've been in business since 2023, and I've been in real estate since 2012, been investing in real estate since then. I'm a partner in over 1,000 units around the country and excited to be growing alongside Rockbridge. They are phenomenal. We've worked together on another deal. Last year, we acquired 100 units here in Lynchburg, Virginia, the Gables of Cornerstone. And Kevin and I met through, I think it was maybe through mutual acquaintances on LinkedIn. I think they were acquiring property in Lynchburg. So he reached out and was like, hey, I see you're in Lynchburg. I'd love to get to, see what you're doing. And so as we got to know each other the last, I guess, probably a year and a half now, I've just been so impressed with the way that they work. We have very similar values and goals. We're really focused on doing right by the investor and providing really awesome investment opportunities for every investor that comes in and making it just really easy for our investors. And so we're going to talk today about Bells Lake and Coastal Wind. I am just going to show you a couple quick pictures. These are the addresses. Again, there's two different properties. There's 39 units at Bells Lake, and there are 56 at Coastal Wind. And so we have some disclaimers here. When you have a chance, pause this, take a look at the disclaimers. We just want you to know what you're getting into and that there are no promises here in terms of projections. These are all projections we're going to talk about. So you can see the table of contents and then the team players here. So I'm going to give it over to Kevin for a minute to tell us about himself and Rockbridge.
Yeah, thank you, Rebecca. Excited to be partnering with you on another deal. Have loved working with you on Gables of Cornerstone and excited just to continue that here with these two properties. Rockbridge, we were started back in 2018. And since then, we've acquired roughly 3,000 units of multifamily, primarily from West Virginia down to South Carolina. We underwrite over 400 deals a year with the goal of acquiring 2 to 4 really high quality assets each year in our target markets. So yeah, we're ultra focused on coastal Carolinas. We've been looking in Myrtle Beach for a really long time. Have made tons and tons of offers and are just excited to finally get one that just pencils really well. And as we'll get into throughout the presentation, we just feel extremely confident for the way we're structuring this deal and just our ability to operate it and really outperform here. So, in addition to Rockbridge and Tailored Investments, we have some more team players that are really important for the success of this deal. The main one being Carlisle Residential Properties. They also manage our asset in Lynchburg called Gables of Cornerstone, which Rebecca mentioned, and they've done an amazing job. Our regional manager, Katrina, actually has a house 5 minutes from Bells Lake. So, we know we're going to get all the attention we need from an on site perspective. And then if you've invested with us before, you'll see some familiar players from our legal team to our lender to our insurance.
So in terms of the executive summary, this is just a high-level view of the deal and what we're looking at. You can see that from the debt side, there's 13.8 million that we're taking out in debt. We'll talk more about the debt piece later on in the presentation. The equity side is 6.5 million that we're raising. And so we've already got a lot of interest in this deal. I think we have one 1031 exchange that's going to come in. And how much are they putting into that, Kevin? Remind me. It's like one or two. Remind me.
Yeah, 2.3 million, roughly one third of the equity for the deal.
Yeah, so it's exciting. We already have some of the equity piece spoken for, but this just gives you a layout of the preferred return 6%. And basically, what that means is our investors are getting the first 6% of distributable cash flow that's coming out of this property before we, as the GP team, get paid. It's a very simple split. It's 80% to our investors, 30 or 20% to us as the GP team. In the past, I've seen a lot of 70-30 splits. This is an 80-20, so it's even better for the LP investors coming into the deal. The year one cap is 6.7%. Stabilized DSCR is 1.6, which is really strong. Equity multiplier is between 2 and 2.5 times. So if you put 100,000 in, we're projecting that at the end of the hold, between the cash flow and the exit, profits that you'll make, that you would get back that initial 100 plus 100 to 150,000 in profits on the back end. So in total, so it's a strong return. The equity again required, we mentioned the 6.5 million. IRR is 16 to 18% for the LPs in this deal. Again, there's 95 units that we're purchasing. The average cash on cash is between 7 and 9%, very strong. The minimum investment's 100K. And then we hit on the debt already, and the whole period is 5 to 10 years, which is a bit of a range. We're not setting anything in stone. It's really going to be based off of, where is the market? Where's the real estate market? Can we get what we need to sell it at on the back end to meet these returns or beat them? So we do give ourselves a range here because we want to make sure that it is the right time and it makes the most sense and we can get what we want and that our investors are happy with the returns that we're able to deliver to them. So the nice part about this though is that there will be cash flow throughout. So it's not like you're just sitting on an asset that's not performing. In terms of the equity structure, very simple. Again, it's favorable for our LPs. We always put LPs first. That's what I look for in deals. I know, Kevin, we are very driven to take care of our investors and make sure that the risk that they're taking by putting money into these deals is worth it, that they're getting the first share in the profits. And so 80% to the limited partners, 20% to the GPs. It's a simple waterfall. There's not a lot of complications. I've seen a lot of complicated deals out there, and this is super simple. And so again, on the cash flow side, we're going to hit that 6% pref and then have the 80-20 split thereafter. And then the equity ownership, at the exit, the disposition is again 6% preferred and the 80-20% upside participation. In terms of the returns, this is just breaking it down and giving you an idea of what it might look like. And I just want to reiterate, none of this is guaranteed. These are projections and the property has to perform. I do think that Rockbridge and the team is very conservative. I've seen that in the deal we did together at the Gables of Cornerstone last year. I've seen that in all their underwriting I've ever looked at. They're just really conservative and I appreciate that. Kevin, I don't think you hit on this, but Kevin used to work for Fannie Mae for how many years again? Was it 4 or 5?
Or
Yeah, 4.5 years at Fannie Mae. I mean, he underwrote thousands of deals and he's seen a lot in his time. And we've seen the market change a lot over the years, especially as interest rates have risen. And so I appreciate about Rockbridge that they're super conservative and they're not putting crazy numbers here that aren't achievable. So you'll see here that the returns that we're projecting over, say, just 5 years. This is a look at 5 years. Again, it could be up to 10. But let's say you put 100,000 in, you can see that in year one, your cash flow would be around 6,000. And then each year it'll go up a little bit, up to the $8,000, $9,000 range. So that cash on cash is increasing over time. And then at the end, when we sell, you'll see a return of capital and then the sale or refinance proceeds there on the back end. So the total return, if you add in each year of cash flow plus the back end return of your principal and profit, it's very strong. We're again looking at that 2 to 2.5 times equity multiplier, average cash on cash being 7 to 9%, and the IRR being 16 to 18%. So pretty basic, nothing crazy there, but it's a strong asset. We're going to dive into that here in just a minute. I'll talk about the business plan. I'm going to start off and then Kevin's going to follow behind with more on the business plan. But we are looking at build to rent, and we're going to really dive into that here in a minute. We're excited about this because they're basically brand new. I mean, one was built in 2023, the other one was built in 2024. So there's not going to be a lot of repairs and things that we have to do. We are setting money aside for capital expenditures, but it doesn't need anything, because it's brand new. So we're getting this market leading product with amazing floor plans, fenced in backyards, garages at Bells Lake, and we're getting it at a really good price. And so I mean, the discount's huge. Kevin will talk about that here in a second, but we're just getting that favorable downside protection. These are townhomes. The Bells Lake group, the 39 at Bells Lake, are actually individually parceled. And so if we ever wanted to go and sell these off individually, that puts us in a really good position. That's not our business plan. We're not looking to go sell them all off individually, but we probably could hit our numbers tomorrow after we purchased it if we did want to go sell those off individually, just because they're selling individually at such a higher, amount right now. And again, we plan to hold this for a minimum of 5 years, so they will have appreciated over that time. So there's a good opportunity in that space and a lot of downside protection. It also assumes that they're not going to be the market leader, that there's going to be other high quality, newer products built in the market. Also, we're buying a stabilized asset. It's already, over 90% occupied. And I mean, it's nice to buy something that we don't have to come in and totally lease up, which there is some amazing opportunity on that front. We'll talk about it at a later time with another new asset that we're looking at. But I mean, there's just a great opportunity. We're avoiding that, lost lease over the first 2 years of ownership by buying a stabilized asset. And then we've got long-term fixed debt, which also puts us in a good place. We'll talk about that here in a second. But, we're getting a good interest rate, a great going in cap rate. And so the business plan just at the beginning is it's really strong. Like I said, Kevin's going to talk a little bit more about this.
Yeah, so and some of this we'll dive deeper on later on in the presentation, but just a couple things that really stick out on this slide. First of all, is that this isn't our first built for rent deal, and Rebecca's going to explain more of what built for rent is and kind of how it's different from a traditional apartment complex. But we've acquired roughly 60 million in built for rent assets over the last 12 months alone. And on those assets, we've averaged over 95% occupancy. We're paying out to our investors over 6.5% on one deal, over 7.5% on the other one. And we actually bought those from this exact same builder. So, really at a high level, you're getting into a brand new asset that we're buying directly from the builder off market. Extremely, just booming market, fastest growing market in the country over the last few years as a percentage. So you're buying a great property in a great location with really high quality construction and interiors. So yeah, really exciting deal with a lot of just good things going for it from a market to an asset standpoint.
So build to rent, I'll let Kevin talk about this more, but it's really a great opportunity for people that, want to be a homeowner. A lot of folks out there today want to be homeowners, but it is expensive to buy a place. I mean, interest rates are still really high, around 7%. And it's really tough to buy right now. So this gives you the opportunity to live in what feels more like a home, but you still have all the amenities of traditional apartment complexes. You've got, and we'll talk about amenities here in a second, but these are townhouses. So you're not on top of each other like in an apartment complex. You have a little bit more space. And it gives you some flexibility of feeling like you're in a home, but you're not in an apartment. You've got the flexibility with 12-month leases. You have location freedom. You're not tied into owning a home where you can't get out. You can move around if you like. And it's bridging that gap between apartment living and home ownership, which is a challenge today. It really has become more expensive. And so we provide really quality living environments for them in these spaces. And I mean, I think it's just a really great product. Like Kevin mentioned, I mean, the other product that they have already with D.R. Horton that they purchased is just doing phenomenal. So this is just expanding that, which is a great place to be.
Yeah, and then just to kind of expand on just speaking to the growth of the market, you can see just a chart here that shows what home prices have done in Myrtle Beach over the last 5 years. So this chart shows that the median home sales price in December of 2019, so 5 years ago, was $150,000, and today we're at over $300,000. So, that's single family homes. We're talking built for rent. These are individually parceled, so it does still fall in that same category. But beyond, just speaking about, how we can eventually go sell, these units for probably a lot more than we're paying. We're paying, roughly 190 a door on average across these two properties. this just shows the demand that there is for living in Myrtle Beach. When you go down to Myrtle Beach and you meet with the residents who are living here or the property management staff, most people are actually not from South Carolina. They're coming in from, New Jersey, New York, places like that, Maryland. And there's jobs here and the cost of living is better and you've got great weather and you're near the beach. So it's a really easy sell. Um, and then I guess the only other thing that I'll hit on from this slide is just speaking to the kind of conservatism from an underwriting standpoint. Our underwriting, we're expecting that rents for Bells Lake and Coastal Wind are going to be lower than actual rents that have already been signed. So just to give an example, at Bells Lake, we've had leases signed $20 higher than our expected rents. And at Coastal Wind, it's even more significant. It's $295. We've had leases signed. So the reason we're doing that is we just want to be able to come in and know that we're going to execute on the business plan and under promise and over deliver. So we're not saying that we're going to increase rent $295 on day one, but the market and these properties have already proven the ability to do so. And then when you look at how much home prices have gone up, you know, that's kind of who we're competing against because a lot of these renters, they're either going to buy a house or they're going to live in a really nice, brand new, built for rent townhome. When you have your mortgage well over $3,000 for the standard townhome in this area, and you have to put 10% down as a down payment, or you can go rent here and you're paying under $2,000 a month. It's a really good proposition for these residents.
Yeah, absolutely. And I love too, I mean, Kevin, I don't know if we really dove into this, but the fact that you've built this relationship with D.R. Horton, and I mean, this was off market, like explain a little bit more about that. Like, why are we getting it at such a good price as well?
Yeah, it's a great point. So basically, with D.R. Horton, we've been building a relationship with them for a couple of years. We literally went down to their ranch in Texas and spent a week with them, hunting with them and learning more about their business model and explaining who we were. And the result has been that we've been getting some really good off-market deals where they may be in a pinch where they were under contract, it fell out, and they need to close by a certain date. Well, then they call us and say, "Hey, can you do us a favor and close this deal? We'll give you a really good price." And that's exactly how this deal came to be. They had this under contract at significantly higher of a price than we have it under contract for. We kind of said, "Hey, we're not willing to pay that, but let us know." And they basically had us offer it, where it made sense for us, which was significantly lower. And that's kind of how we got this deal.
Yeah, and being that they're a publicly traded company, they're really balance sheet driven. I mean, that's that they just want to get this off their books. And so for them, they're willing to take a haircut a little bit on it, right?
Exactly. Yeah, they need to free up space on their balance sheet to go do new deals, and they just need to move this, and they're willing to meet the market just to sell it.
Absolutely. Yeah, that's awesome. So well done. Kudos to you guys for building that relationship. And you can see, I mean, Kevin already kind of alluded to this in terms of the affordability. I mean, for you to go and buy in this area a comparable townhome, you're going to pay around 385,000 for that. Then you're going to bring 10% down, 38,500. Your mortgage is going to be off of 346,500. So your payment every month you're looking at around $3,089. And that's, including your tax or insurance or HOA fees. But then you've also got your maintenance on top of that, which you have to take care of as a homeowner. It's fun. I have a lot of issues, every once in a while I have a little bit of an older house. And so things pop up, like it's just part of it being a homeowner. You also have that reduced location flexibility. So again, why wouldn't you, if there's a chance you're not going to be here long term, or you're just not wanting to spend over $3,000 a month, you can come and live in one of these brand new places for, 1925 at Bells or 1645 at Coastal. And you've got a lot of space. Again, that Bells Coastal is at 1,489 square feet, 1,141 over at Coastal Wind. You don't have to deal with ongoing maintenance. The landscaping responsibility is not yours. You've got trash, fenced in backyards. I mean, I would like to go move into one of these. It sounds great, to not have to worry about all of that. So we're seeing that in a lot of places. It's just becoming harder to buy. But when we're getting something at such a good price, it really impacts like the spacing, the margin in there for us, for our investors to make really good money on this deal. And you can see a recent study by CBRE reported that the average monthly new mortgage payment is 52% higher than the average rent. That just blows my mind. It really is the most affordable like option right now. Yeah, it's just amazing to see how things have changed. And not to say it will always be like that, but in terms of capital expenditure, again, they don't need anything right now, but we are setting money aside just to be on the safe side. We've got 237,500 for the interior budget. We're setting aside 350,000 for the exterior budget. So the total being around 6184 per door that we're going to have in a just a high yield savings account ready for a rainy day if anything happens. And again, that conservative nature with this plan, with our partnership, I think is we both want to be conservative. And so I think this puts us in a good place in case anything happens, which things do at times. Just to look at what we're setting money aside for. And then Kevin's going to dive into the rent comps.
Yeah. So, from we kind of already hit on this a little bit, but the seller has already signed leases significantly higher than what we're underwriting here. So as you can see, Coastal Wind, we're assuming we're going to get rents at $1,800. Bells, we're going to get rents at 1925, and that's well below what's already been signed on site. And then when you more importantly look at other sites, what the competition is doing, you can see we've got 2 and 3 bedroom townhomes or apartments that are signing leases between 2,100 and 2,400 with an average rental rate of roughly 2,200 for what we would say is comparable property. So when you look at it from like an actual chunk rent, what we're charging, we're $300 to $400 lower than the competition, and then on a dollar per square foot basis, we're lower as well. So again, we just feel really good because these properties are 3, 4 years older than our properties, and we're assuming our rents are going to be lower. Obviously, our goal is that we're going to actually get rents higher than our competition because we have better product and we're in a really good location. But this is just kind of a way to show, hey, we think we can outperform here. And then, yeah, so just from a property perspective, 2 different assets, as Rebecca mentioned, Bells Lake's 39 units, Coastal Wind is 56 units. And I guess just to kind of reiterate, these are brand new construction built in 2023 and 2024. So a lot of these units haven't even been, turned yet. So you have the first resident that ever moved in still living there. And, the other thing to point out here is when you look at the average square foot of these properties compared to the market, they're significantly larger. So that's a really just a huge benefit because when you get larger units, it feels more like somewhere where a family, would want to stay and live for a long time. When you're living in an apartment that's 600, 800 square feet, it can be great for a time, but your turnover rate as a property owner is going to be a lot higher because people are looking to upgrade, have a bigger house, maybe have a yard. But here, everybody has their own backyard. They've got their own patio and, they can let their dogs run around out back and their kids, can play there as well. And it just really feels more like a home than an apartment. So just, again, great actual properties.
Yeah. One thing, let me ask Kevin about this was one of my initial concerns when we were looking at this deal was the insurance piece, being that it's a coastal town and insurance has really risen over the years, especially in like Florida and California, some of these states where they're hit by storms, hurricanes. Speak to that a little bit and why that was not a deal breaker for you.
Yeah, so whenever you're in coastal markets, you definitely have to be careful. So the way we look at it is we assume that our insurance cost is going to double over the hold period, and we're going to have one catastrophic loss, meaning, if we have a building go down, we're going to have to put up a heavy deductible in order to get that insurance claim moving. And if the deal still pencils after those sort of draconian, assumptions, then we feel good about it. The other just couple things to hit on is neither of these properties are in a flood zone. So our insurance is going to be more attractive than if you're buying a coastal property in a flood zone. And the fact that they're brand new construction, there's a reason why insurance companies are focused on insuring brand new construction over older 60s, 70s vintage assets. It's just higher quality construction and what we've actually seen on our portfolio is our built for rent assets year over year have on average the premium from 2024 to 2025 has gone down 5 to 10% depending on the property. So coastal markets has some new entrants coming in, and when we first underwrote this deal, our insurance that we were underwriting was like 30 or so percent higher than what we're actually going to probably end up getting here at the end of the day. So yeah, you just have increasing competition because a lot of people pulled out of the coastal markets and rates went up, and now they're starting to come back in because they're realizing, hey, the risk, maybe isn't as high as what some of these other insurers are saying, and they're going to pick their spots. So like brand new construction, not in a flood zone, is ideal.
Really good. Thank you for sharing. In terms of the amenities, I mentioned this a second ago. There's a lot of great ones. There is smart home technology in every unit. Energy, they're very energy efficient, being brand new. They have ADT alarm systems. There's granite countertops, double bathroom sinks. They all have in-unit laundry, stainless steel appliances. There's a whole house window treatments. They don't have to worry about bringing their own treatments in. There's again private fenced backyards, the pet-friendly community. I think that alone will keep people there long term. I mean, so many people these days have pets, and so if there's space for them and for kids, to have the chance to run around in the back in their own space, like that is such a big draw, and that's a reason why people will stay like year after year after year and keep renewing their leases. And then again, there's garages at Bells Lake, and so that's just a great amenity as well. I mean, there's just not a lot of reasons why somebody wouldn't want to live here. I feel like the amenities just really speak for themselves. There's some more pictures you can see. It's really a pretty place. I'm going to be there in April. I'm so excited. My family actually went there for vacation 2 years ago to Myrtle Beach, and I was blown away. I never spent any time there before. We vacationed all over South Carolina, but never Myrtle Beach, and our kids loved it. It was such a great place. And again, it's not just a vacation place. We're going to hit on that here in a second with the market, but it's a beautiful city with just a lot happening that is booming. It is growing.
Yeah, some people, especially on the East Coast, have been to Myrtle Beach and they've been there for vacation and that's it. And that is certainly a large driver for the local economy. But one of the nice things is, with that population growing over the last, 20 years, really, there's been tons of other industries that have popped up as a result. And also, which is part of the reason why people are going there is because there are jobs. And one of the things we look at whenever we want to go into a market is we definitely want to go into a market that's going to have above the national average for employment growth and population growth, which Myrtle Beach does have. But we also want to make sure that there's not a single industry that is dominating the market. So as you can see, leisure and hospitality is a major growth driver in the market. However, there's also a good diversity of industry beyond that. So you've got trade, transportation, and utilities making up almost 20% of the employment, which that's a very stable, kind of employment base. Utilities are not going anywhere. Trade and transportation as well that includes things like Walmart, and, grocery stores, those sorts of jobs that are really staples in communities. You've also got, local government, which makes up roughly 12% of the employment. You've got education and health services. There's a couple of universities here in Myrtle Beach. And then we'll get into it on later slides. There's been a few hospitals that have really grown a ton to accommodate the growing population, as well as the heavy retiree population that's moving to the area. And then you actually have a growing manufacturing industry, which we'll highlight some new announcements there recently. And then financial services is there as well. Other than that, just a couple quick things here on this slide. The average household income at Bells Lake with existing residents is over $100,000. And at Coastal Wind, it's over $70,000. The average across our portfolio is roughly $60,000. So that just kind of speaks to the high quality nature of the built for rent, brand new construction assets. You can see that the median household income, is lower than that on site because you're really getting the best residents in the area who want to live in the nicest property. So on this slide, just some of the major employers. If you look at like the top 10 employers, all of them is what I would consider pretty recession resistant employment, employers. So you've got education, you've got government, you've got healthcare, and then there's Food Lion and Walmart. Those are all kind of employers that you wouldn't really expect to go anywhere if there is a recession. Like if there's a recession, people still need to eat, people still need healthcare. And actually, typically, I believe, I could be wrong. Somebody can check this in Chat GPT. But during recessions, I want to say university enrollment typically goes up because people go back to get degrees and that kind of thing. So again, just wanted to show like there's a lot of employers in Myrtle Beach. It's not just a tourism destination. And of the top employers, most of them are what we would consider to be pretty recession resistant. So a couple just recent job announcements. I would encourage you to pause this and read through it. I won't read through every one, but you can see some big names like Amazon and Google who have come to town and announced, some high-paying jobs in the area recently. You also have a data center company called DC Blocks, which recently announced plans to expand in Myrtle Beach. And then this is something interesting. It's worth looking into if you're considering this investment is just look at the various industrial parks in Myrtle Beach that are set up in a way where they can attract, you know, 20, 30, 40 manufacturers to come set up shop in Myrtle Beach over the next 5 to 10 years. Um, Horry County, which is where Myrtle Beach is, really is focused on growing that manufacturing base. And as a result, developers have gone out and set up industrial parks like the Ascot Valley Industrial Park to accommodate that growth. In addition to that, one that I thought was really interesting, the Pittsburgh Institution of Aeronautics announced that they had a job fair where 100 of their students received offers on the spot from 7 different employers in this specific region. So you basically have a huge need for aviation mechanics. There's not enough people getting trained to actually work in this sector. But interestingly, Boeing and GE have plants between Charleston and Wilmington, North Carolina. So, kind of in those markets and in between, there's been a growing need and just desire to train people to serve that sector. And Myrtle Beach has actually attracted a lot of employers and also as students who are looking to get into that industry. And then, so yeah, just in terms of the market, you've got Coastal Carolina as the major university. They've got over 11,000 students as of fall 2024. And they actually had a 15% increase from 2023 to 2024 in applications. So it just shows the increasing demand to be in Myrtle Beach, especially if you're a college student, being near the beach and being able to go to school is obviously extremely attractive. But you can see from the job opportunities in North Carolina, South Carolina, Myrtle Beach, it makes sense to go to school here because there are a lot of job opportunities once you get out. And then I guess another thing just to hit on, so there's 3 longstanding hospitals that are in the Myrtle Beach region. They include the Grand Strand Regional Medical Center, Tidelands Georgetown Memorial Hospital, and I always botch how to say this, but McLeod Loris Health. Basically, these have all expanded their bed counts and their capacity over the last few years just to service the increasing need just with the growing population and a lot of retirees moving to town. But that's also a huge employment base, nurses, technicians, even just maintenance individuals working on site. And then the entire industry that's built up to serve that, that healthcare sector. And a lot of those jobs are also very high paying. Anybody who knows somebody in the med sales device world, that's a large industry. And a lot of those people are living here in Myrtle Beach. Last thing I'll hit on this slide, well, 2 more things. One is the growing aerospace industry. So the aerospace workforce has grown by over 600% over the last 10 years. That was study that Horry County released. And again, that just is a result of what we mentioned before with the plants in between Charleston and Wilmington. And then the last thing here is coastal markets have really boomed over the last 5 years. And over the last 20 years, Myrtle Beach has led the pack by far, growing roughly 100% over that time period. So we're getting into the coastal Carolinas in this investment, but we're also getting in the #1 growth market within that region. So again, just speaking to the extreme attractiveness and just demand in Myrtle Beach. So Bells Lake and Coastal Wind are in 2 different submarkets of Myrtle Beach, which is a benefit because you kind of get some diversity there of location and who's really living there. So on this slide, we kind of just wanted to show that there is, like, if you look at the top 10 employers, they're all relatively close. Like the furthest you're really going to have to drive is 20, 25 minutes for the top employers from either one of these properties. So again, just wanted to highlight, people are moving here because there are jobs in close proximity. So yeah, we can go to that next slide. So Rebecca already hit on this a little bit. So I won't expand too much, but the one thing I will point out here is um, the 6.7 year one cap rate. So basically, what that means is if you just take the revenue minus the expenses, you get your net operating income, divide that by your purchase price, you're at 6.7%. So the higher the cap rate you're buying at, the better deal you're getting. So just to give an example, there were deals in this market that sold for below a 4% cap rate. So we drove two properties that sold from the same builder 2 years ago, sold to two different buyers. The rents were lower at the time of sale, the occupancy was lower, and the unit count was lower. So all of that would lead to a lower price. However, one of those deals sold for 309,000 a unit. The other one sold for 450,000 a unit. So I think those people definitely overpaid. But when we look at our underwriting and what we're buying this for, we're buying this for roughly 190 a unit across both deals. And we're assuming that we're going to be able to sell for around 270 a unit. Um, you know, and that's where you're getting that kind of 16 to 18% IRR. If we sell anywhere close to that 309 to 450 a unit, these returns are going to jump off the chart. So again, just kind of speaks to us trying to be as conservative as possible, in our underwriting.
Mm. And you were saying, Kevin, that you and Connor recently went to the largest multifamily conference out in Vegas last month. And I mean, hearing you talk about there's just nothing else out there that get this kind of deal that's cash flowing at this amount right from the get-go that's brand new, right?
Yeah, I mean, when we were out there a few weeks ago, like you mentioned, Rebecca, and basically people were just asking us like what we had going on, and also were pitching us on new deals. And we tried not to share too much because we don't want everybody buying these deals that we're buying. But when we told people roughly what we were paying for the deals we had under contract, they just could not believe it. To give another example, we recently looked at another operator's deal. They're actually building brand new built for rent in Ohio, and the units are smaller, the rents are lower, the exit cap rate is higher. And they are building those units at over 300,000 a unit. So they're going to have to take on, an unattractive loan. They're going to have a long development process, and then at the end of the day, they're going to have a property, completely vacant at 300,000 a unit that they're going to have to lease up. Here, and that's in a market that's not growing like this market is. Here, we're paying 190 a door, and the property's completely occupied at closing. So it really is a very rare opportunity and one that we are, very excited about.
Absolutely. Thank you.
And then, so on this slide, there's not, I guess the one thing I would highlight is if you look at our economic occupancy, meaning if we're 100% economically occupied, that means the property is completely filled up and everybody's paying rent. 100% occupied, everybody's paying rent. We're assuming economic occupancy of below 90%, which Rebecca, you've seen tons and tons of deals. Nobody underwrites deals, that low economic occupancy. So again, that just speaks to us saying, hey, we want to make sure we're being conservative here. We're underperforming and under promising and over delivering. So we really feel good about kind of where we're underwriting this deal. And we believe we'll be able to outperform expectations pretty well, especially on the revenue side.
Yeah, absolutely. In terms of the debt financing, it's pretty straightforward. We're getting fixed debt, which we love. We would much rather be in fixed debt. It is a 10-year loan term. It is a Fannie Mae loan. We are getting 5 years of interest only, which is also really nice. There's a 30-year amortization schedule, and then the loan amount is 13.8 million. The fixed rate's going to be around 5.9%. As we get closer, that could shift a little bit, but that's what we're looking at. And then the LTV is 75%. So again, very attractive fixed rate financing with a well-established lender who we've done a lot of other business with.
Only thing I'd add here, Rebecca, is if we were to rate lock this deal today, we'd be roughly 20 basis points lower on the rate. So we'd be like at a 5.7% interest rate. So that could change, but right now we're underwriting higher than what we expected to actually be.
Absolutely. Yeah. We are also going to do a cost segregation study to take advantage of bonus depreciation. If you don't know about bonus depreciation, it is such a powerful tool for real estate investing. And I would just encourage you to do a little bit of research on it to find out more about how it will impact you if you get into this deal. It gives us the chance to depreciate things quicker. Typically, there's a 27.5 year schedule on assets purchased, but when we do this study, we're able to depreciate things a whole lot faster, bring it forward. And so in the first year of this investment, you'll see, and this is an estimation, we don't know for sure what it will be at, but between 20 and 40% year one paper loss. And so if you're still going to get money in your pocket, you're still going to be getting cash flow from this asset. A couple of distributions will happen in 2025. But on paper, it's going to show that you have a loss. And so that's a great place in the sense that if you have other passive gains that you're trying to help offset, this could really help, make a big difference for you. I actually just recorded a webinar a couple weeks ago with a CPA that's just focused on real estate. He's an investor himself. He also has a tax strategy armed to his business. And we really dive into some of the benefits of real estate and investing and cost segregation. And so if you have a chance, check that out. That's on our YouTube page. But I think there's just so many ways that you can make such a big difference in your income when you're investing in real estate. And a lot of people just don't know about it. And so please make sure you have a good CPA that you're working with and, look at this opportunity. And we may even have higher, it really depends on what the administration does with bringing back 100% bonus depreciation. This could look a little different, based on that.
So we underwrite and look at you want to look at, best case scenario, worst case, and then likely. So that's kind of what the slide shows is just a few different sensitivity analyses that we do to just kind of gut check, the risk on the deal. So just a couple, examples. We looked at if we had no rent increases at all from current rents, what would our debt service coverage ratio be in year three? And as you can see, it's a 1.4, which means that our net operating income is roughly 40% higher than our debt payment. So plenty of cushion. And to speak to that point, the vacancy shock, we look at what is our break even occupancy, meaning if our occupancy goes down, how low does it need to go for us to just be at break even? So we can lose, significant occupancy, we'll go all the way down to 73% occupancy and still pay our expenses and our debt. We don't have any properties that are that low occupancy, so we feel good about that number there. And then if you look at the cap rate analysis, this is interesting, just to see, hey, if we do get interest rates going down significantly, what could that IRR look like? So if cap rates, for example, go down to 4.75%, which is higher than they were a couple of years ago still, but lower than where they are today, that IRR can go up significantly to like a low 20% based on our projections. And then on the flip side, if rates go up and cap rates also expand significantly, where are we at on an IRR basis, assuming all else equal, and you're still kind of hitting like a 12% net IRR to our investors. So we just feel good about, hey, this deal isn't completely driven by an exit price. There's cash flow in the meantime. And if the market does turn a little bit, we still have plenty of cushion to generate a great return for our investors. And then again, just we keep things really simple. So on this deal, we're charging a 2% acquisition fee on closing. We charge a 2% asset management fee, which is just based on the rent every single month. And then, as Rebecca mentioned, we do a 6% preferred rate of return and then an 80-20 split thereafter. Very simple. And then we don't charge a disposition fee, which many groups do. And the reason for that is we just like to make sure we have interest aligned. We don't want to be incentivized, by a fee to just sell a deal if it doesn't make sense. So that's why we kind of took the disposition fee out, while many other groups do still have that.
Yeah, and with the quarterly distributions, there's also going to be quarterly updates sent, so you'll know what's going on at the property. If you ever want to come visit, we can arrange a visit and you can take a walk through it. So we love for our investors to be a part of, what they're purchasing, what they're a member and ownership of.
Yep. And then just to hit quickly on the timeline, very simply, if you're interested, reach out directly to Rebecca, and she can walk you through the portal if you don't already have one, and also walk you through reserving your shares. Very easy process within InvestNext. And then, from a timing standpoint, we believe that this deal will close in early May. So we're looking to have all funding in by April 25th at the latest. We'll be taking funding in much earlier than that, starting in early March. And if that timeline shifts for some reason, Rebecca will definitely reach out and let you know. But high level, looking to have all funding in by the end of April and then closing in early May.
And the documents that he mentioned will have a PPM, the private memorandum, an operating agreement. And so they are lengthy. If you have questions about it, let us know. We have an awesome legal team that's putting these documents together. So know that there's a lot of thought that's put into it. And we outline, the risk involved and all of that in those documents. So please make sure you spend some time on them. Don't just sign them. You know what you're getting into. In terms of the just FAQ, frequently asked questions, this is a 506B offering, so it is open to both accredited and non-accredited investors, but you do have to have a relationship with us. We need to know you. So, make sure that you schedule a call or let's make sure that we're having some interaction here. We can't go publicly advertising this deal. You can send it over to friends that might be interested. We would love for you to share it, but maybe just let us know beforehand that you're sending it to someone. We want to make sure that we cover all of our bases and we're doing this the right way. Again, the investing in the deal, the sponsorship team will be investing in the deal. We're really excited about it. It's a growing market. One of Kevin's partners, David Acosta, lives in Wilmington, really close to Myrtle Beach. And so he's right there. I mean, able to pop in and out as needed. In terms of the funds that we're accepting, we are accepting cash, retirement funds. This is a great opportunity if you want to diversify outside of the stock market and get into real estate. You can use your IRA or solo 401k. I have a list of custodians that I'm happy to pass along. So please reach out if you like that list and, have some conversations about what it would look like to, direct those funds to an investment like this. You could also do a combination of both of them. So that's something to keep in mind. And then investor distributions will begin quarterly, probably 3 to 6 months after closing. We don't have the exact timeline based off of closing, hopefully being in early May. And then the cost segregation study, again, will be performed in year 1. So stay tuned for that. And with that, we're going to wrap it up. Thank you so much for listening to all of this. We're so excited about the opportunity to acquire these 2 assets in Myrtle Beach. We're excited to potentially work with you. And so thank you for being here. If you have questions, please reach out. We're happy to help. We're an open book. I'm happy to share anything. Kevin, thank you for your time. Thank you for your partnership. I absolutely love working with you guys. You're a fantastic company, and it's exciting to be doing another deal together.
Absolutely.
Yeah, yeah. Thank you so much. Happy to help if we can in any way. Take care and have a great day.